All right, so the crypto market just sent this huge bullish signal, but it came with a multi-billion-dollar catch that honestly changes everything. What looked like a clear shot for recovery now has this hidden layer of extreme risk. And the data tells a really fascinating story of strength fighting against some serious instability.
So is this just a little relief bounce, or are we looking at the start of the next real leg up? That's the big question on everyone's mind after a pretty rough correction. And for a second, it looked like we had the answer. But a massive complication just threw a wrench in the whole thing, making the path forward, well, incredibly uncertain.
First, let's just quickly touch on the good news. There was this perfect moment where it really seemed like the absolute worst was behind us. It was all thanks to this perfect storm of bottom signals. What's so cool about this is how these three totally different indicators all screamed the same thing. First, you had your short-term holders finally throw in the towel and sell at a loss. That's your classic capitulation. Then, selling pressure in the futures market just completely evaporated. And finally, the stablecoin supply ratio, which is basically a measure of buying power, hit a solid floor, signaling that a ton of cash was ready to jump back into the market. So, with all those signals lining up, the data was pretty clear. A solid foundation for a bounce was officially in place. The stage was set for the bulls to take over.
And they did not mess around. The second the sellers were tapped out, buyers just stepped in aggressively. This wasn't some slow, careful recovery. It was a decisive move to completely grab control of the market's narrative.
The weekend was totally flat. I mean, nothing was happening. Then, all of a sudden, right in the final hours of Sunday trading, the price starts to climb. Now, this is a huge deal because it's happening right before the weekly candle close, which is a really key moment traders watch. And that last-minute surge created a 2% pump that set a powerful positive tone for the entire week to come. And this right here shows you just how important that pump was. It wasn't just random noise. It successfully defended two absolutely critical levels. For Bitcoin, staying above its previous all-time high is a massive psychological win. And for Ethereum, closing the week above that key 39.95 resistance line basically turns an old ceiling into a new floor. From a purely technical point of view, this was a huge, huge win.
Right when the picture looked perfectly bullish, and the path forward seemed totally clear, a new piece of data came out of nowhere and completely flipped the script, revealing a hidden danger right underneath this rally.
Okay, this is where the picture gets way more complicated, and we're not talking about a small detail here. This represents a massive, fundamental, and pretty risky shift in how the market is structured right now. $2.8 billion. That is the amount of new money that flooded into the crypto derivatives market. And get this, it all happened in a single 24-hour period. That is just an explosive amount of new capital. So the really crucial thing to get here is that this wasn't just $2.8 billion of new investment. A jump this huge in what's called open interest tells us this rally was heavily, heavily fueled by leverage. We're talking about traders borrowing money to make much bigger bets. Think of it like pouring jet fuel on a fire. Yeah, it can make the flames shoot way higher, way faster, but it also makes the whole situation far more volatile and dangerous. And this massive injection of leverage completely changes the game. That jet fuel we just talked about, it means any move from here on out, up or down, is going to be amplified. An upward push could be even stronger, but any little downturn risks becoming a violent cascade of forced selling. Well, it leaves us in a really tricky spot. On one hand, you have this confirmed bullish price action, but on the other hand, that same action is now balanced on a knife's edge of extreme leverage, and that creates a ton of instability. Now, if you look back at history, these kinds of leverage-fueled moves actually succeed and push prices higher about 3/4 of the time. But that other 25%, when they fail, the failure is absolutely brutal. A little downturn triggers a cascade of liquidations that can just vaporize accounts and send the price crashing down in a matter of minutes. The analyst who provided all this data uses this phrase to describe this exact scenario. It feels like you're just diddling in the middle. You're caught in this weird, uncertain neutral zone with no clear, safe direction to go. And this is really the ultimate takeaway. That period where buying felt like an easy, no-brainer win is officially over. If you're thinking about entering the market now, or even adding to a position, you have to know that it carries way more risk than it did just a few days ago. Caution is absolutely key. So, this leaves every single trader facing one last critical question. We have a bullish setup, but it's built on a foundation of high-risk, borrowed money. In a market that's this supercharged, how do you balance that clear opportunity with the very real danger of a catastrophic reversal?